Morgan Stanley's Mike Wilson writing this. The data tell us growth and inflation are slowing directionally, and the Fed will be easing this year as a result. Under such conditions, quality growth outperforms. When in doubt, it pays to go with the highest probability winner. In this case, it's high quality growth. Mike, I'm pleased to say, joins us now for more. Mike, it's good to see you.
Yeah, great to see you guys.
Good morning. Fantastic to have you with us around the table. We'll get to stocks in a second. I want to talk about the outlook. A convictionless outlook was a theme in a recent note of yours. How convictionless are things right now?
Well, look, we spend time with clients all the time. That's what we do for a living. And I would just say that, we had this big rally after, the pivot. And I would say it started with the Treasury squeeze when they said they're going to issue less coupon. So it was really a duration rally that then fed into a stock rally. And so now valuations are stretched again, and people are looking around going, okay, what's next? What's the next catalyst? I think there's going to be a couple things that will determine the direction. Number one, how much deceleration do we get? Okay, we'll come back to this banking question. I think that's, to me, that issue it's not a systemic issue. What it is a weight on credit growth. Okay, like the regional banking system is just not lending at the same rate that they were because they're constrained, and that's been our view all along, which means quality stocks will continue to do better, right? The companies that are reliant on that kind of funding are going to continue to see that's a paperweight for them. And I think that's the main takeaway from the banking situation. And then, of course, new themes will evolve. Last year was about two main themes, right? It was about GLPs and AI. So can those two themes continue to drive the stock market? Yeah, to some degree, but it's probably going to morph a bit, and then there'll be new themes. And I think that's what investors are looking for now, looking for new themes to kind of latch onto in a world that's going to remain macro uncertain, is the way I would say.
Can you identify any themes right now?
Well, I think the AI theme is the one. Instead of enablers, we're going to adopters, right? So that's probably the biggest theme we have as a firm. The GLP one is sort of positive and negative, as we've seen, and that's a great thing for long-short investors. And then I'm wondering if we're going to get some growth out of the international markets finally. International economies have not really recovered from the pandemic yet, for the most part, and I think that's a wild card. So if that were to happen, that could be a great theme for EM. It could be a theme for things that are levered more to global growth as opposed to just the U.S., which has really been the only engine of growth.
Since you say that you fly around and you talk with clients, I was just noticing some of your recent travels. You were recently in Miami.
Yes.
I imagine you're getting a lot of points, by the way. You talked about the AI stock, saying, I think it's the Magnificent Four now, and it's related to earnings. Who are the Magnificent Four? Who gets dropped?
Yeah, well, I think it's, we're not talking about specific names, but I think it's obvious. People have been talking about this too. I'm not the only one, right? We're seeing, you can identify which stocks have fallen off. But what we look at is earnings, okay? And I would say there's a Magnificent One, quite frankly, that has real top-line acceleration growth. Everybody knows what it is. And then the other ones are a bit more cost-cutting stories.
It rides with NVIDIA?
Yeah, and my sense is that what we're going to see here is a broadening out in quality growth. So in other words, when we do our screens on quality growth, only 27% of that basket is in IT. Another 10 or 12% is in comm services. So that leaves another 60 to 70% of the S&P 500 that kind of qualify for that high quality growth bucket. And that's what should happen. We should broaden out if we have a soft landing that doesn't have other issues. And that's the other thing that we've been really trying to help clients with, is give them a framework on the macro. That's what we do. And say, here are the three buckets, okay? Soft landing with decelerating growth and decelerating inflation. That's kind of what we had last year. It's high quality growth. A soft landing with accelerating growth and maybe stickier inflation. And that's an environment where you can see a broadening out, perhaps to lower quality areas. And then the third scenario is still a hard landing. We can't eliminate that. And I think that's going to be how, that's going to determine how you position your portfolio from a stock standpoint.
How do you hedge if you are cautious and there is this uncertainty? Is it energy stocks? Is it more duration sensitive stocks? How do you even understand what it means to hedge when you have such bipolar types of outcomes?
It's diversification. You got to be diversified. Now, one of the things we talked about at this conference as well, which didn't make the headlines, is this idea that we finally have very attractive real rates and nominal rates to some degree. So from a portfolio construction standpoint, okay, this is the first time in 15 years where you can bonds actually provide their diversification benefit. And we saw that yesterday, right? Bonds rallied, stocks were down. So, we're very bullish on, we've been bullish on duration since 490 on a 10-year. I mean, so here we are, whatever, it's probably not as good a value, but in the event that this something systemic does happen, there's another shock to the economy, that bond portfolio now is, the yields are high enough where they can actually provide some diversification to your equity risk, which means you can take equity risk, still up the quality curve, okay? So it's a diversification between stocks and bonds, and then understanding what within the equity market you feel more comfortable with. If things get better on the economic front and we see better growth, then we can go out the risk curve in equities. We can take more equity risk as long as we have that duration benefit on the bond side.
You mentioned that change in theme from AI enablers to adopters. Where should I be looking for adopters? What does that mean? What does that look like?
Well, it looks more non-tech, right? So who are going to be the early adopters within, the adoption of tech, AI as a cost, benefit, as well as driving new growth. Now, we've written about this already. We think it's more of a 25 story.
Okay.
Like the productivity story is really 25. So we're not that bullish on earnings this year relative to the street. Street's at like 244, bottoms up, we're 230. That's the typical pattern. It will probably come down to our 230. But then for next year, we have 266. That's 16% growth, and a lot of that's going to be driven by productivity improvements as this is adopted. I don't think this is a second quarter, first, second, third quarter, even fourth quarter. It's going to take a little bit of time. But our analysts, we wrote a report recently, bottoms up report, identifying the potential winners in that, and the market will probably start to sniff that out sometime during the year. They're not going to wait all the way until 2025, but that runs the gamut of industries away from tech.
Are they labor-intensive industries?
They can be. It can be labor-intensive, but it can also be growth drivers. I mean, like if you use AI to, as an effective way of marketing, like as a cheaper way of marketing to get new customers. I mean, we don't know yet. This is what's exciting about it. It's also uncertain. There's also going to be a lot of losers. Okay. Now, one of the things that worries me a little bit about AI in the short term, we've seen a lot of layoffs recently within the tech sector. So, maybe these guys are already seeing the benefits and they're able to remove headcount. So, the labor market, I think there's various views on the labor market. I mean, our view is that it's slowing, it's weakening, a lot of government jobs, a lot of healthcare, social worker type jobs, which are somewhat government related. And if companies get efficient, this could be an interesting catalyst actually for more layoffs potentially. So it's going to be uncertain, right?
Okay, I just have to ask this because I get messages all the time. You're such a downer. Why are you so pessimistic? When you go around and you're talking to different clients, how much pushback do you get to just sort of a more realistic view of the potential risks, given that only the rosiest seem to have come to pass?
Well, look, I mean, our clients are active managers, right? So they're not worried about the S&P 500. They're trying to find what works. I mean, for all of the headlines we get around the S&P 500, I mean, what we usually talk to clients about are individual sectors and stocks and like what's going to work. And so like last year we get an F on S&P, but we get probably an A or B on being in the right places in the market. And that's our job. And then that's what active managers are trying to do. So, you don't have to be super bearish, it's not about being bullish or bearish. It's about being bullish in certain parts of the market and opportunity and being cautious or concerned about others. And look, last year was a really great stock picking market. That most stocks, up until October 27th had a tough time. And then we had this little rally at the end of the year. And we've been very consistent about this over the last 12 to 18 months, as you guys know. I mean, we don't think the trade is to then go to the lower quality bucket, okay? To go for the low quality cyclicals, and like that's a recession trade. We're not in a recession. You need a clearing event. That was our call in 2020. Then that worked really, really well. Don't overthink it, right? You need to buy the high quality growth stocks, and it's not all Mag 7. All right, there are other businesses that have those characteristics who are maybe not as appreciated.
It's the Mag 4, it's the Mag 1. Lisa making friends, I love how you did that. Well, do you get the feedback that I get? People hating on you for being gloomy?
Oh, yeah, all the time. It's okay. I mean, honestly, I actually don't think I'm all that gloomy, but sometimes.
Not at all, Bramo, not at all. That brand is so unfair. I agree. Mike Wilson, you're going to stick with us from Morgan Stanley,
So
I'm pleased to say.